The majority of the stocks in the S&P 500 ended negatively, with some mass anticipation of what the Nvidia post-market results would mean. And what we can in fact see, they did report some very strong revenue growth, around 122%, which they talk about being due to the massive demand they are still having for their data chips. And this is something we will run through in today's episode to take a closer look at the numbers. But what we can in fact see, post-market, this company is down around 7%. We're going to take a look at their report, which was very positive, but unfortunately there are some issues that companies like Nvidia face when they are essentially priced to that perfection point, and we want to understand where are the issues, where do they lie, and ultimately whether or not Nvidia is a company we should be considering adding to after their drop on what we would consider to be fairly good earnings. So first things first, let's take a look, and the headlines do tell us that they did beat Wall Street expectations, and on top of that they provided stronger than expected guidance for the current quarter. And we already understand that Nvidia is essentially the market leader in what we do believe to be an artificial intelligence boom, which is going to be here for a very long time. And in fact, we could argue that Nvidia is leading the global market into this space. Now, when we look at the exact numbers, first thing to note, looking very good on the earnings per share, 68 cents versus 64, which the market was anticipating. Do remember, when we have looked at this company over the last 4 quarters, they have beaten analyst targets, so they continue that trend. And we also see some very strong growth, just over 30 billion to the top line, when the market, as we can see, we're anticipating just below 29. So a very healthy double beat, and in fact for the next quarter they're anticipating 32.5 billion, which is massive. Again, more growth expected, not just from the same quarter last year, but also from the quarter they have just essentially reported. And we can in fact see this would translate to an 80% increase from their same quarter last year. Now, you could argue the revenue has started to slow down. We see a 122% increase on an annual basis, something we have been spoiled with Nvidia, as we can see. For the last 3 years, on a year-on-year basis, they have been increasing their top line in excess, so more than 200%. A lot of people will not worry and say that 122% is still very strong, but there will be some analysts out there who may be thinking that the top line is going to start to reduce very significantly, and that can play a part in what we will come to discuss shortly. We also know when we do look at their bottom line net income, in fact looking very healthy, 16.6 billion. That is more than double what they produced in the same quarter last year, which, as we can see, came in at 6.18 billion. So looking very healthy, and as we can see, their market cap is more than 3 trillion, and whilst they were once the most valuable public company, although for a short time, they are now second to Apple. And if you do believe this boom is going to continue, it may not be a very long time before we do see them take that number 1 spot. Now, we'll continue to touch upon some of these details in a bit more depth shortly, but we also just want to highlight this company's historical performance. As we mentioned, just something to reiterate, they are down 7% in the post-market. Will be interesting to see how that forms when the market opens tomorrow. Over the last year, still very strong, up 168%, and no surprises for everyone who has been following this stock, up 24,765 just over the last 10 years. Now, when the market does open, we will see this come down slightly, so they are now trading in the mid to upper end of the 52-week range. And we also know Wall Street still maintains that strong buy, seeking out for a hold, with quant giving it a hold. Now, we just have to mention this, they do offer a yield very small at 0.03%, but just a few months ago, in fact from their previous quarter, they did increase that dividend at 150%, and we do know their forward P around 46.5, S&P around 23, and we'll also briefly touch upon how that forward P will drop over the subsequent few quarters. So let's take a continued look at the numbers that they did report. First thing to note here, on a total basis, as we mentioned, more than 30 billion to that top line, looking very good, a lot better than what the market had anticipated. Now, from the previous quarter, 26 billion, so again a very healthy increase, and from Q2 of last year, 13.5 billion, so that is more than double, so again very very healthy, and some of the numbers that institutions as well as market analysts will be looking at is that data center growth continuing. We see the growth in the gaming sector as well as the professional visualization, and in fact both the other two sectors as well. Not something we actually saw in the previous quarter. We noted that the gaming had come down in Q1 from 2865 in Q4, as well as the professional visualization and OEM and others. So very nice to note, not just on the data center, which is the key highlight for the market, but also in the other sectors as well, their top line has been increasing. And we also want to just point out some concerns that we do have about this company, even though some of these numbers do look very strong and very healthy. First thing to note, as we said, 30 billion in this quarter. Now, when we look at it on a quarter-on-quarter basis, it is up 15%. One thing to bear in mind, analysts do like to be forward-looking. They will look not just over the next quarter, but also over the next year, and they will be hoping that they continue to grow at a very strong rate. Whether or not double digits will still satisfy them on a quarter-on-quarter basis, that is something we will need to wait and see. But ultimately, year-on-year, up 122%. Remember, over the last 3 years, they were up more than 200% on a year-on-year basis. So a few questions just to ask yourself. And one of the main things that I was a little bit disappointed in is essentially this gross margin, 75.1%. That is lower than the previous quarter of 78.4%. And one thing I did mention in previous episodes on Nvidia is not just the top line growth that we will want to focus on, but also either increasing margins or at least maintaining it. So a little bit of a worry that they have started to decrease that margins. Are they in effect reducing their prices to increase their top line? Is that something that is going to cause an issue further down the line? So just something to think about. Although when we do zoom out and look over the last year, it is still up from 70.1% from last year same quarter to 75.1%. As always, these are just questions to consider. Bottom line net income 16.6 billion, a lot better in fact just from the previous quarter, up 12%, and we can see up triple digits from the same quarter last year. EPS also looking very healthy, up 12% on a quarter-on-quarter, as well as triple digits in terms of a year-on-year basis. So overall, there are a lot of positives, and we wouldn't say there are many negatives. Just a few things to consider with that valuation that we will come on to shortly as well. And now we just want to talk about some of the issues that companies do face when they are essentially priced in for perfection. And as we said, overall earnings did look very healthy. But one or two things that we do want to discuss. The first one is forward looking, and that is essentially the sales they're anticipating for the current quarter that we are in. They believe it will jump around 80% to 32.5 billion. Bear in mind, as we just discussed now, it's gone from triple digits of in excess of 200% down to 100% level, and now they are anticipating this to come down further to 80%. And whilst they are anticipating 32.5, even though analysts were expecting around that level at 32.5, we have some analysts who believe the actual whispers from the markets were hoping for a higher level of 33 to 34, which is why we did in effect see that drop in the post market. And it doesn't just stop there in terms of what the market was hoping for. We also have the discussion around the margins that we did touch upon as well. It slipped around 75.1% from the 78.4 from the previous quarter. So that is a little bit of a worry. Is it going to continue to fall? Are we going to see a company like Nvidia come down to the double-digit revenue growth as well as margins coming down from the high rates that we have previously seen? And in fact, for the full year, we can clearly see here they expect their gross margin to be in the 70% range, and we can see the market was hoping for around 76.4. So just a few things that you do need to consider here with this company, but ultimately we still believe this is a very high quality company, but the valuation has to be correct. Are we buying a high quality company that continues to deliver at the right price? Is it undervalued, or in effect, are we looking at a company that is actually inflated and we should consider to either pull back our position or just hold it and maintain it for now? Now, before we continue, just to let you know, we have released our latest free weekly article where we run through 3 undervalued high quality growth companies. If you want access to this or any others completely free, do click on that pinned comment below where you can sign up and read straight away. We've also released our 35 undervalued stocks for your consideration in the month of August, where we run through those that sit within our own portfolios as well. You can grab a copy by clicking on the pinned comment below, and I will will be sending the September edition on Monday. Now, continuing our analysis, the other thing we want to talk about is both insiders and institutions. Are they buying? Are they selling? Well, starting off with insiders, ownership at 4.23%, we have around 832 million worth of sales over the last year. And when we look at it from a quarter-on-quarter basis, we see some very large sales just over the last two: 313 million in quarter two, 313 million in quarter three, around 339 million in quarter two. And when we look exactly at who these insiders are, in fact, the majorities are the CEO. Now, his more recent sale was the 9th of August, where he sold a 120,000 share tranche, and we can see that netted him just over $12 million. Now, he has done this quite a few times over the last few months, and this shouldn't take us by surprise. This is something that was already pre-arranged, and he had disclosed this, and ultimately he does hold a very large position in this company. So not something we would consider bearish. Ultimately, insider selling isn't a bearish signal. Insiders sell for many reasons, whether it's personal or financial. What we ideally want to spot by looking at insider movement are the buys, as they do give us a sense that they are buying because ultimately they believe the share price will go up. Now, when we look at the same thing for the institutions, what we can see here is 65%, with around 7.3 billion worth of sales over the last year, with significant amount more buys over the same time period. And in fact, when we look at the more recent quarter, Q2, 257 billion worth of buys with only 9 million worth of sales. So ultimately, institutions do love this company. They are continuing to buy. But one thing we do want to make clear on this channel is that you should never buy or sell based on institutions. Always do your own due diligence before executing on any companies. Now, we did take a look at their top line revenue, but we also want to point out their bottom line. Their growth over the last 10 years has been incredible, from 4.7 billion in January 2015 to around 60.9 just in that more recent annual report. So growth does look tremendous. And one thing we just want to highlight in today's episode, just in this more recent quarter that they just released their earnings today, they released 30 billion of revenue for one quarter. Just look at their last full year, 60 billion. So they made already what they made in half the year in 2024 in just one quarter. That is some very large growth. And when we take a look at their bottom line, again, looking very strong, going from 631 million to around 30 billion. So this is a company that is increasing rapidly, both top line and both bottom line. But the main question we need to understand in relation to the valuation: do we believe they can continue to grow at the rapid rate, both on the top line as well as the margin, and on top of that, their bottom line, which is ultimately very important to shareholders as well. We also want to highlight the health of this company from their latest earnings, their total cash versus their total debt. 4.6 billion in 2015, around 31 in their latest quarter. So they do hold a lot of cash. One thing that we actually haven't mentioned already is that they have just announced a 50 billion share buyback program, which is very good news for investors, essentially returning excess cash to your pockets, giving you a larger portion of control of the company. And we are going to take a look at some of those metrics shortly. But as always, when we do look at this number in isolation, it doesn't tell us anything, which is why we do take a look at that in comparison to their total debt, numerically and directionally, going from 1.4 billion in 2015 to around 11 billion, which, as we can see, their cash position is much, much larger. It wouldn't even take them one day to pay off all of their debt and net of cash on hand. So even though this has been increasing over longer term, no worries whatsoever. We also want to just show you some of their earnings reports from the previous quarters. Now, over the last 4 quarters, they have beaten analyst targets. In fact, quarter 2 they just released, as we mentioned, they beat on the EPS. So last 5 quarters, a 100% track record. And moving forwards into the next 3 quarters, they are still expecting some strong double-digit growth to the earnings per share. And ultimately, if they do hit their January 2026 EPS, the forward P will come down to around 33, which you could argue for a high-quality company is a lot more reasonable than the forward P that we currently see. Then taking a quick look at some gradings. The first one, the valuation and underlying metrics based on the updated numbers and figures. Now, they do get an F rating. No surprises here, because ultimately, for example, the P on a non-GAAP basis of 46.55 is much higher than the sector median of 23.6. So this means if you are paying right now for one share of Nvidia, you are paying, in comparison to the sector as a whole, a 97% premium. And as always, whether it's 97% or 9,000%, there are reasons why companies do trade at a higher level, and you could argue it is justified, it is warranted, but that is the conclusion we need to come to before buying these shares. And we can see, regardless of what metric you use for the valuation purpose, this company is graded very poorly because they do trade at a significant premium. Now, when we take a look, for example, at the growth, we can see they have been giving an A+, so this is one part of the warranty that is justified for this company. In fact, the last year on year, we saw 208%, just based on the more recent quarter. Looking back over the last 12 months, even though this has dropped around 122%, we can still see much higher than the sector of 3.42. Moving forwards, as we said, around the 80% level, still significantly higher. And one of the things we like to draw your attention to, the EPS per share over the next 3 to 5 years, 37% growth, looking a lot better than the sector median around 14.7. So lots of positives so far. Granted, though, the valuation is a little bit costly. And when we look at the profitability, well, an A+, gross margin still looking very strong at 75%, given the sector is at 49%. Bottom line looking absolutely phenomenal of 53%, way better than the sector of 3.63. And finally, the main thing we want to draw your attention to, one of the reasons they can do those massive dividend growths, those massive share buybacks, their cash from operations of 40.5 billion is significantly better than the sector of 96. Now, a quick conclusion for this part of the analysis. We still have a strong buy from Wall Street, still a double hold from the other two analysts, an F on valuation, A+ on growth with an A+ on profitability. Finally then, before we look at some underlying metrics, just to compare Nvidia to others in this sector, I'm sure you've heard of them all: TSM, Broadcom, AMD, Qualcomm, TXN. What we do note over the last year, with essentially the peaks and troughs Nvidia has faced, they are still the best performing, up 168%. And no surprise, when we do look over the last 5 years as well as the last 10 years, no other company comes close. So whether or not that will continue over the next 10, 20, 30 years, whatever your investment horizon is, no one knows. Past performance isn't essentially an indicator of the future, but historically this company has performed very, very well. Now, for those that just want to know, the yield is very small, but the dividend safety score still sits at 89 safe. As we mentioned, that triple-digit growth to the dividend of 150% in May 24. And in the last recession, well, what we do note when looking at the key metrics, so from the Great Recession 07-09, they paid no dividend, so no comparative data. Negative 35% recession sales, which was well below the average of the S&P's negative 12. And they ultimately also underperformed, negative 78 when the S&P came in at negative 55. As we mentioned, great growth just over the last few months, but over the last 5 years, as well as the last 10 years, it hasn't been that great. Essentially, dividends aren't something that this company focuses on. It is just more of a benefit in combination with the share price growth, hence why now they'll only have 1 year of consecutive increases, although they have been paying a dividend for the last 11 to 12 years. Now, dividend yield theory is something we do look at on this channel. We look at a lot of dividend companies. However, this yield is very small, not a focus, so we won't draw your attention to this. We'll instead look at the forward P, and what we can see from this, the current forward P is pretty much in line with the 5-year average of 42.6. So you could argue that currently, right now, based on this metric alone, this company is reasonably valued. But as always, we never conclude on valuation until the end of the episode. We then get to the free cash flow payout. As always, we look at that over the earnings, which is susceptible to manipulation by management through accounting. Below 50% for the industry, 1% in 24, 2% over the next 12 months. It's understandable why this company can continue to increase this dividend at a triple-digit rate. And the free cash flow per share is something we do love to look at on this channel. We want consistent increases over the longer term. With Nvidia, it has been increasing rapidly, in fact, over the last 10 years, but we do know the mass growth came from 23 to 24, and over the next 12 months, for the full year of FY25, we are expecting more than 100% growth. This is still a company right there in the initial phases of this massive growth. Then we look at the sales growth. Well, this is one thing you do need to consider. As we just mentioned, it has been growing at a very rapid rate. And as we did look at the numericals, we did see 5 billion in 2015, going up to 61 in 2024, and a large number is anticipated for FY25, so it is still moving in the right direction. Just the question remains how long they can keep this consistency for. As we talked about already, they have announced a 50 billion share buyback program, but over the last 10 years, you will notice you would have seen shares outstanding increase, so they would have diluted your position, although we would say that if you did see the share price, you wouldn't really care about this aspect. But essentially from 2022, they have been doing share buybacks, something they are continuing continuing to do over the next few quarters, as we mentioned with that newly established program. ROIC, as always, 10% or more or 12% for this industry. Give us faith, management are able to effectively allocate their capital. Numbers looking very, very good. 61% in 2024, 78% on a trailing 12-month basis, so no issues there. And the margins, well, whilst it does look very, very strong, not only noting the consistency over longer term above the minimum levels, but also the operating efficiency from 16 to 54, our question still maintains whether or not they can keep that high level we have seen over the last few quarters. Free cash flow margin also looking very good, well above the minimum 5%. 45 in 2024. This is a strong free cash flow machine. Finally, the net debt to EBITDA, referring to the earnings before the interest, tax, depreciation, amortization. Below 1.5 is what we want to see. Numbers below that you can see relate to the number of years it would take the company to pay off all of their debt net of cash on hand. Not even one day over the last 10 years, not even one day over the next 12 months. And remember, this correlates to dividend safety, balance sheet strength. So it does look very, very good when we talk about those elements of the company. Now let's jump into our valuation model. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now our intrinsic value of $140 still remains unchanged from previous episodes, and how we got to this value is we ran it through the DCF model. We have the free cash flow year on year. Now over the last 5 years, this has grown by 135%. Over the last 10 years, 94%. And as we saw, just over the next year, they're anticipating to grow more than 100%. So what we've done is we've gone for a low, medium, and high rate, 25, 30, and 35, where we've ultimately gone for the 30%. With the discount rate of 8%, we got the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get the equity value, divide by the shares outstanding, and as you can see here, the 140, which ultimately gives 20% upside. Now these numbers are very subjective. You can always grab a copy of this model by clicking on the pinned comment below, putting in your own numbers, whether it's for Nvidia or any others. And for those that believe that number is way too high, well, at a 25% more conservative level, it does bring the intrinsic value to $100, which does give in fact downside of 14%. For those that believe it should be higher at 35%, well, as we can see, 192 giving essentially a 64% upside. And in previous episodes, we have run through Bloomberg, who talk about this industry as a whole over the next 10 years increasing at 42% year on year. And for those that do believe that is in fact more realistic, they do believe this industry is going to continue to boom and we are moving into a complete new era, then we can see 296, which does ultimately give 153% upside. However, for today's episode, we're going to take that median rate of 30%. As we can see, the 139.79 intrinsic value. And as always, on this channel, we do use an MOS, 10%, which we execute if it meets our 3 golden criteria. Wide moat, strong financial metrics, good forward-looking data. A buy at 126 if you believe that. Then we keep going till it's near the current trading price. And we can see in today's episode is not at the 20% level just yet. It does sit around 15% up to 119. But do remember, when the market does open tomorrow, we could see a lot of volatility. It could continue to go down or it could recover. And we do see Wall Street have updated their price forecast upwards. In fact, they now have the price at $150 over the next 12 months, indicating 28% upside. As always though, do give us your thoughts in the comments below. Is this one based on the earnings you're looking to buy the dip? Maybe this is one you hold and are going to continue to maintain your position, or maybe you are considering selling after the earnings report. As always though, do give us your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button. Don't forget to sign up to the free weekly newsletter below. And as always, come and join us in the Patreon where we do run through our buys and sells. As always, have a great day and we'll see you all on the next one.